Well, Kunal, super excited to connect with you here and talk a little bit more about inflation. Obviously, this is a topic on everybody's mind. Is it inflation, stagflation, vibeflation? Are we all just sort of feeling inflation, and is it real? I think from an e-commerce perspective, we've certainly heard a lot of folks have different perspectives on it. So excited to hear from you. I would love for you just to kind of tee us up, tell us a little bit about yourself, Ampla, and what you guys do, and then let's jump into this thing and talk a little bit more about what you guys are seeing.
Sure. And again, Michael, thanks for having me. Super excited to share everything that you mentioned, because it's all of the above, and obviously trying to figure out how best to get our customers through this unique period. A lot of operators, a lot of brands were born out of COVID and saw a completely different macro. Especially on the Ampla side. So just a little background on myself. I actually founded my own food brand. It was called Boo. We made better for you bouillon cubes. Bouillon cubes, I know, are not something that are popular with like the millennials. It's always something when we would talk to people like under the age of 40, they'll be like, oh yeah, that was something my mother or grandmother used to cook with. Those would probably be 2 out of the 10 people who would say that. The other 8 will be like, we have no idea what bouillon is. So it was a unique experience, and it was an amazing opportunity because it's a category that was dominated by the big brands, right? So like, Knorr with Unilever and Maggi and all that stuff. So we ended up selling that business last year. I ran it for 4.5, 5 years, worked with a lot of the major retailers like Whole Foods, Target, Kroger, Walmart, etc. And I can definitely say we gained a lot of experience, a lot of those mistakes that I am always happy to share with customers of what we learned from that. But what was even more awesome was, we were an early borrower of Ampla at that time. Ampla was just getting started. They were called Gourmet Growth at that time. And obviously, what we do, our hero product is our growth line of credit. We provide, working capital for consumer brands in pretty much any consumer industry. And we approach it, in a way which makes a lot more sense than like your traditional asset-based lenders. Instead of just giving a percentage of what your accounts receivable and your inventory is for any given month, we're actually looking at the cash collections of a business. And everything here is integrated through tech, right? So we built out connections for accounting software, banking software, digital marketing platforms. So we get a holistic view of the business in real time. And then based off of what we're seeing in cash collections on a monthly basis, we're lending anywhere from 100 to 250% of that, again, taking other factors of the business into consideration. And it's a true revolver, right? Yeah. So as you can draw as much as you want, you only charge one standard APR. But we've obviously seen quite a bit of a rise in demand because of the current economy. It's a lot of brands within the CPG space. My experience lies more in food and beverage. There's the need for capital because you're not really going to be profitable in year one. A lot of people do project in year 2, but we see that happen more in like year 3, year 4, beyond, and beyond. And it takes a lot of capital to get there, for sure. Yeah.
And maybe that's a great segue into maybe a setting for this conversation, which is, you've got a lot of folks, you're seeing an uptick in demands coming your way. How prepared do you think the average kind of e-commerce D2C brand was for the market conditions that we're seeing today? Obviously 2020, as you said, the macro environment's changed significantly, right? Like everything we heard was like, hey, we've done 5 years of growth in 1 year, and this is going to, accelerate the trend to D2C, and everybody's, switching over, and all of a sudden everything comes crashing back down to earth in the last year, both just in kind of the demand side, supply chain disruptions, obviously, that impacted businesses. But I think the inflation piece was one that a lot of people missed. And I'm just kind of curious from your perspective, people coming to you, where were they at? I mean, were they ready for this? Were they thinking about it? Was it on anybody's radar coming into this year?
Yeah, great question. And I wish I had a different answer, but the answer is no. People were not ready for this, right? And we're seeing this kind of across the board with all different types of companies, whether they are selling, strictly D2C or strictly retail wholesale, or obviously a mix of the two, right? I think, what COVID kind of brought out was, I would say, the integrity of the U.S. business person, right? Like, they saw an opportunity and they're like, you know what, I can start a business around this, and I can go out and start selling online through my store, or start getting onto all of these different platforms that, help sell your products as well. And
People
a lot of
trapped inside start coming up with great ideas,
Yes, exactly. They're either making some product within their kitchen, or they're building something out of their tool shed, whatever it is. And, they actually were able to start a legitimate business, right? And because of the huge shift into online commerce, a lot of these brands were seeing a lot of success, right? And they were able to really market on digital platforms such as Facebook and Google, and really drive a lot of sales, right? So then they were seeing these, great numbers from like a ROAS perspective, from a customer acquisition perspective, et cetera. And then I think the first kind of wrench that was thrown into everything was the iOS updates, right? Now it's, getting a bit difficult for customers to be able to track kind of customer behavior, and the targeting became a lot more difficult to do. And what we saw was that the first response from a lot of these inexperienced operators was like, oh, you know what, let's just throw more money at it, right? So let's just, up our spends on Facebook and Google and all these digital platforms. And then we should be able to get our customer acquisition costs right, or let's try to increase the prices of our products to increase AOV. But then, the ROAS took an even worse turn, right? And, now companies are struggling. They're like, well, what do we do? Now we have so much money that's going out there, and we're not really achieving these ROAS numbers. Okay, let's go and raise some capital, right? And I will say that, the economy was a lot different, call it 6-9 months ago, where equity capital was, very available. Like, we saw a lot of VCs that were like, send deals our way, we're opening up, all these rounds and raising all of these different funds, et cetera. And they wanted to invest in these types of businesses, right? To find whether it's like the next RX bar or smart suites, et cetera. And again, when you're an operator that's, starting a business, and you're not really taking into consideration the macro and what could potentially happen, right? And have sound financial planning, that money that you raise, they think is like free money for them to test out all these different things, right? And then when you're starting to test out all these different things to try to achieve certain unrealistic targets, now that cash gets depleted, and now you end up in an even worse spot before you raise that capital. Now you have people that you have to answer to. So it was concerning. There were a lot of brands that we were in the process of underwriting that probably would have been approved, call it a couple months prior to where we got a bit more stricter with our underwriting as well, right? So it's one of those things where now we're looking at the fundamentals of a business, right? Is a company growing efficiently? And are they taking all factors into consideration of their actual business? Are they focusing on margins? And I'm probably going to say the word margins 1,000 times throughout this webinar, because it is so important for people to understand how you need to constantly improve gross, net margins, contribution margins in order to be successful, regardless of what your volume looks like.
Yeah. So, and maybe this is, there's two sides obviously to inflation. And I think, what we want to focus on here, obviously, is kind of the operator side of inflation, right? Like, how is this impacting my ability to run my business? So maybe we'll just touch on it briefly here up front, since it's come up in relation to some of the iOS changes that have happened. As an operator running a business, and since you have experience as an operator, how is the inflation kind of directly impacting businesses in the sense of inflation from the consumer side, right? So if I'm a consumer, I feel like I've got less cash in my pocket. You've got that there in kind of your second bullet point. What are the considerations that I need to be making about my business to reflect the sense that consumers are going to have that, hey, like I'm just not going to buy two of these, I'm going to buy one of them, or this was a luxury item that I'm just not going to buy anymore. And how do you address that or think about that as an operator, as the market kind of continues this trend for probably, at least, I mean, as far as we know, for the next several months at least.
100%. Like you hit on it, right? Like as inflation increases, the cost of products increase, right? Even from an operator standpoint, your raw goods components, your manufacturing, all those costs are going to increase as well, which is going to chew into your margins, right? So now consumers,
I saw IKEA is raising prices on everything. As much as 80%. If IKEA is raising prices,
there's a problem.
Raise prices too. There is no way you have a better supply chain than IKEA.
Exactly. And then what that obviously does, right, is now consumers are going to start tightening the belt, right? They're going to start really trying to understand, well, do I need this product? Do I need that product? The discretionary spend comes down, right? And for operators themselves, they really need to take a look at their actual products and again, go back to their actual margins and get an understanding of what makes sense. What is the consumer looking for right now? Like a clear example of one tactic that they could potentially implement is, first and foremost, I've seen a lot of brands that get a little too heavy on the number of products or SKUs that they have, right? They feel like they need to have every single possible flavor or every single possible color of one specific item, right? In those situations, we've recommended to our customers, hey, really do an analysis of which products of yours are actually moving the needle, right? Like which one of your products is actually generating, or which 5 products are generating 80% of those sales, right? It's like the 80-20 rule. And if you're noticing that there's quite a few SKUs that are outside of that and are actually potentially just, generating a loss, or you're just break even on them, cut them out, right? This is where you need to really bring in that SKU rationalization, right? Because if you're going out there and you're spending money on marketing, you're spending money on whether it's, other types of expenses and overhead and all that stuff to maintain, I'm not going to call it like, loser products or products that are not generating money, but call it that are generating a negative contribution margin. Those are probably not worth promoting in this type of macro right now. Focus your efforts on what is actually moving the needle, right? And then at the same time, knowing that consumer discretionary spend is going down, what can you do to actually alleviate some of those costs, right? I'm not saying go out there and start putting your products on sale every day, right? Because then that's going to lead to, no loyalty. You're going to hurt your LTV, and you're obviously going to hurt a lot of your your margins as well. But how can you get creative in certain promotions at certain times that the customer can relate to and be like, oh, you know what? This product is normally $50. It's on sale for $40. And I feel like, it kind of makes sense, whether it's, fall coming up and it's a new type of product that I could use for several years or whatever it may be. You need to start, or the operator needs to start putting themselves in the consumer shoes, right? And that's something that we actually did, at Boo, at our company. The biggest thing for us is that, we wanted to get away or get out of this whole mindset that our product was only used for soups and stews and all that type of stuff. So we needed to really understand, what is the consumer looking for when they are cooking their own products? Granted, COVID was great for us. I never want to make light of a terrible situation, but because of us being able to take advantage of the fact that people were cooking more, we showed them more usage for our product, right? So again, it comes back to, how can you go and relate to the actual customer to understand what their needs are?
Yeah. Absolutely. So maybe if I'm a D2C brand, I hit some traction, started during COVID, hit some traction. I had a great idea. I'm an engineer, I'm a marketer, right? And but this is kind of my first rodeo, right? Now all of a sudden rubber meets the road. What are the things that I need to be thinking about? What are the inputs here that I need to, I get it, right? Like maybe there's some products that I need to deprecate, right? Maybe there's some processes that aren't as efficient as they could be. Maybe I'm spending too much money on raw materials or something, right? So
Yeah.
walk me through kind of the process of some of these inputs and evaluating them, and to really kind of impact that maybe that COGS, that margin that I've got on any individual product.
Yeah, I mean, listen, what I always suggest to our customers is literally go into your profit and loss statement and start from the top, right? So you'll have some ideas on how to generate, more top line sales, right? And what I always caution people to do is don't focus on your top line. Make sure that whatever you're doing for the top line is going to bring in a healthier bottom line EBITDA NOI number, right? But in order to be able to do that, everything in the middle is very important as well. So from your gross receipts, you're now going into your cost of goods sold, right? And this is where, you have all your vendors, suppliers, manufacturers that are involved in these processes. And this is where you need to start building on that relationship and actually have open, transparent conversations with them. As far as it goes with raw goods, listen, vendors and suppliers of raw goods and components are hurting too, right? Their costs are going up, their margins are going down. And normally what they're trying to do or will be doing is passing that on to their customer, right? It's this kind of vicious cycle. Then, us being the customers trying to pass it on to either our consumer or the retailer, but then no one pretty much wins. Who actually ends up getting hurt the most is the consumer. So at the same time, it's like, how do I figure out with my vendors and suppliers to alleviate some of these, costs or offset some of these costs by whether it's, can we source more product at one time, right? So, I can commit to more ingredients or packaging or whatever it may be. Maybe I don't take delivery of it all at once, but I know that based off of my forecast, I'm going to be selling 5,000 units of this within the next quarter. How can we potentially increase our contract size to alleviate some of those costs, right? At the same time, really take a look at your packaging too. Is every single component needed to maintain the integrity of my product, right? In a lot of instances, people don't really understand that, they probably don't need this sleeve or the inner cardboard or this outer box, or don't need so many different colors or whatever it may be. And again, I'm not saying go and rebrand everything and do everything again, but don't lose who you are, but also at the same time, you have to go through this exercise just because of the way the current world is, right? And if you can actually look at your products and figure out if there is a way to fix it, have a conversation with your vendors and suppliers. I'm sure that they would be willing to help out as well. Same thing from the manufacturing front, right? It all depends on, if you're a full turnkey solution, right, then you're most likely going to be getting upcharged from the manufacturer for them sourcing all the raw goods components and then manufacturing the product for you. What does that look like as well, right? Is there any savings that we can have there if we do commit to, I don't know, more product or a longer term on our contract? Or maybe if we get a better understanding of production schedules and we do it where it's in accordance with their current kind of, times that they give into other brands, or it just kind of makes more sense because labor is obviously something that they have to take into consideration, line times, all of these things are factors that actually go into the cost of goods and help you save on your margins. Then it all comes down to, and I can't stress this enough, the finance piece, or really understanding what your cash flow is going to look like. I've seen a lot of companies over exaggerate or over project what their sales are going to look like, and then they build their budgets off of that. And then what ends up happening is that while they have missed their top line or their net revenue number, their expenses have either stayed the same or potentially have gone over budget, right? And this just comes down to them believing that, oh, okay, I didn't achieve this week's sales, but I'll make it up next week, right? And they kind of, make themselves believe that it's going to happen because they're changing something or the other. That's, especially in this world right now, you can't afford to do that, just because if you do, missing 1 week's worth of projections could have a monumental effect on the expenses side of things, right? And now you come into this cash crunch to where, oh my God, now I don't have any more capital either for next week or the month after. And then what ends up happening is they start making cuts, and the cuts that they're making end up going to what ends up hurting your net revenue or your gross receipts side.
Yeah. I've always, as a sales, as someone who's been in sales for a long time, I've always felt that if I cut my projection in by about half, that'll probably be much closer to where it ends up landing than whatever optimistic idea I have about where we're going to actually end up. So whether that's a week to week kind of sales number or projecting deals that we're going to close on the software side, whatever the case might be.
Yep. And again, on top of that as well, a lot of people tend to think that if their gross receipts or their gross revenue comes down, that's a big no-no. And, now they're like, the business isn't trending or doing so well. But what a lot of, brands, and I will say the more sophisticated operators have taken this approach where, well, if I'm reducing my gross revenue, that means I'm potentially cutting on certain expenses, mostly on the marketing side, right? And like I said earlier, if they're cutting on those marketing platforms or initiatives that aren't generating a high ROAS, then it probably makes sense for them to do that, to sacrifice a little bit of the top line for more bottom line health, right? And this is where, we do suggest to our customers to really get an understanding of what their true return on ad spend is, right? I think a lot of brands, D2C operators, even the ones in the retail wholesale side of things, they focus on, okay, if I'm spending $100 on marketing and I'm generating $300 in gross receipts or gross revenue, my ROAS is 3x, right? But what they don't seem to understand is that they didn't calculate the cost of actually generating that gross revenue, right? Like, what is your true selling cost? Not just taking your COGS into consideration, but think about all of the fulfillment costs, all of the selling costs, any of the discounts that went into it, any free product that you had to give away. And then once you actually get what that true ROAS number is, I guarantee you, and this has already happened, a lot of brands are shocked that their ROAS isn't even over 1, right? In some cases, it's even negative. So we've always recommended, like, especially for brands and, prospects, that, take a look at what that true ROAS number is. And from there, you can really understand what you need to weed out, right? Because maybe Facebook, if you thought it was generating a 3x ROAS and you started including your selling costs in there, is only generating a half, right? Google is probably doing more than that. And again, it all goes even for the platform cost itself, right? I think this, Amazon charges a lot of money to be on the platform, right? Like, a lot of customers are only netting, 60 to 70% of the revenue that's actually being generated on Amazon. So if you don't have a ROAS that coincides by taking that, 30 to 40% deductions into consideration, you're probably just losing money on every single sale on Amazon.
Yeah. I think we typically see in sort of, a shameless plug of the Blue Onion platform. One of the things that we are able to show people in great detail is all of the different fees and charges that are being taken out by Amazon to enable people and to see, for, in a lot of cases, for like the first time, oh man, like, I can see exactly what I sold. And now I can see net of all of the fees that Amazon's taken. And now I've got this very clear number that I can take back and plug into the rest of my models and say, hey, are we actually generating any real revenue off of, or any real margin on our Amazon channel here? Because it is costly to maintain, and it's an involved channel, right? So, I think that those are the kinds of things that companies definitely are able to benefit from. Are you guys seeing a lot of companies, kind of to your second point here, on the runway, where are companies at? If again, I'm coming to you, I'm, a founder who doesn't have a ton of experience on the D2C side, like what is a good runway to have right now? Where are companies at that are coming to you guys for financing, and what do you expect or look for to be able to give people the kinds of lines that they need to keep operating?
Yeah. Well, I will say this, right? We've definitely seen a very large uptick in the number of applications. Unfortunately, a good chunk of those are coming to us when it's a little too late, right? And it's too late because they're reacting to what's going on. And they've probably been through this exercise where they try to put more money towards marketing to bring the ROAS up or the customer acquisition cost down, et cetera, and burn through a lot of cash. So specifically for us at Ampla, I will say that at the beginning of the year, we were fine with companies who had the ability to have around 3 to 4 months worth of runway on hand, right? And the way that we calculate runway is taking their last 3 months average of cash burn, right? And then determining how much cash they have on hand, and then that will give us the number of months, right? So, if we saw a customer had 3 to 4 months worth of runway on their own, and our line was able to add at least 1 to 2 months on top of that, then they had a good opportunity or a good chance to get funded by us. But as of late, I'll say as of the last 3 to 4 months, we've actually doubled that number or doubled that requirement, right? So we want at least companies to have 6 to 8 months worth of runway on their own, right? Based off of their last 3-month burn. And then us being able to add 2 to 4 months on top of that, right? So we view healthy businesses that have at the very minimum 9 months worth of cash runway. At the same time, it's not one of those things that if they're burning, call it like, large percentage of their gross revenue and that just stays flat, that's also not considered healthy to us. The smarter, more sophisticated operators are going to always try to reduce their burn on a monthly basis, right? And it's not, like I said earlier, it's not just taking cuts to marketing expenses or selling expenses, but unfortunately, in the world that we're in right now, there needs to be a cut to fixed costs if you're overburdened there, right? And a lot of the fixed costs do come from, payroll and everything associated with payroll. So now it's like, consolidating a bit of the team. And trust me, like my former partner was like a big believer in this, is that the more heads you had on payroll, the more success you're displaying to your investors and everything. Yeah. And I never agreed with that, right? We're always about running a lean operation. We were always about running a lean operation. And then we saw the problems as we started to add a lot more headcount. Same thing here at Ampla. We've grown tremendously, knock on wood, since our Series A in November, but we've been very conservative with our headcount growth, right? And we've always made sure that, we're maximizing the abilities and the skill sets of all of our employees, and the people that we are hiring do have the ability to do multiple, jobs or wear multiple hats. So again, having cash on hand, like I say here, cash is king, right? And no one knows how long this is going to last. I mean, news broke out, at the beginning of the week that recession is now at 100% likelihood, right? So how long that lasts, no one really knows, but what can actually get you through it is cash.
Yeah. And that kind of gets to maybe a segue back into, the world we're in right now, right? It's October. We're headed into the holiday seasons. I think companies obviously have spent a lot of time over the summer. If you're even an average operator, I'm sure you've been trying to figure out, some of these pieces of the puzzle here, right? How do I extend my cash runway? How do I improve margins? Do I need to cut some products, things like that? But I've probably built in a lot of assumptions about what's going to happen over the holidays, right? So I've made some guesses about, what's going to happen, here through the end of the year and into the new year. And maybe I'm curious what you guys are telling people right now, what you're seeing on the front lines in terms of just kind of where things looking like they're trending for the holiday season in 2022.
Yeah, we're definitely, a lot of our brands obviously are expecting some big sales, through kind of Black Friday, Cyber Monday, through the holidays, et cetera, right? And, we agree. We do believe that a lot of these brands will experience a significant uplift during those holiday season, right? Because even the consumer, if you think about it, maybe they have conserved their spends, leading into the holidays, knowing that they are going to be spending more or have to spend a certain amount of capital. And we tell our customers to not over forecast, right? Because we've seen a lot of brands who may have kind of struggled in Q3, or maybe they're getting some type of customer feedback to where they're looking forward to like these holiday sales, et cetera. So now they start increasing what the projections are going to look like for the holidays. And my first thing is no, do not do that. Whatever you had set it for, January of this year, and let's take a look at what it was, prior year. Let's stay kind of close to that, right? I don't think that a lot of brands really understand kind of the consumer mindset is that they're probably going to spend very big during November and December, but it's going to come back down drastically when Q1 2023 starts, right? I don't think you're going to see a lot of these sales. And again, this is very, kind of product driven, brand driven, whatever it may be, where you're going to see a lot of retention, call it, through the early part of 2023. It's just because of the macro that we currently live in, right? Again, people are going to continue to conserve cash. There are a lot of doubts. There's not that much confidence in what's going on. There's a lot of talk about these rate hikes, right? And when the end is near, and to tell you the truth, I don't even know if the Fed knows when the end is near, because they really don't even have a good handle on what inflation is going to be and what it's going to look like. So I always tell our customers, prospects, be cautious, because you'll probably experience a significant uplift, but it's not going to bleed into the next quarter or two. So be prepared for those sales to come back down, and make sure that you're building your projections or your budgets off of those, when the sales do return to normal, right? When they do normalize. And a lot of customers, completely, they agree. I hope they get it. I hope they're taking action towards it. But at the same time, they also believe that by increasing sales during the holidays is now when they look more attractive to investors, right? Because sales have gone up, revenue's gone up. Now I should be getting a higher valuation. I don't need to dilute myself that much. So I'm just going to wait till those sales happen. And that I tell them, you can't wait, right? I know that it's difficult to raise capital, especially for those brands that are looking, but I rather own 50% of something rather than 100% of nothing.
Yeah. Well, and it's interesting. I mean, you've got something like half of the current, Shopify stores were founded in the last 3.5 years.
Yep.
So, you're talking about companies. Now, obviously the people behind those companies have been through some ebbs and flows, but for many of them, this is the first time running a, consumer products brand, D2C brand through a cycle like this, and understanding, the impact that this might have on a model as we've got here is hard for people to really kind of internalize, right? It just does. It feels like you've got to just sort of put the numbers on the paper and just trust it without, and go against your gut in some case, where you're like, now we're going to make all this up in December, right? November, December, because your last two cycles were everybody sitting at home with a bunch of extra cash in their pockets because they couldn't go out to eat, right? So now all of a sudden you're faced with a bunch of people who are saying, my groceries have doubled in price, and so I can't go out and buy a bunch of skincare products that I thought that I wanted, right?
Yeah, absolutely. And this is where, I tell a lot of our customers, and why, we at Ampla are big fans of Blue Onion and what you guys are doing, is that it's necessary to seek the advice and be able to get this type of data to work with professionals within this space that have the experience and knowledge and know-how that can guide you in the right direction, right? So to really have an understanding of what your platform fees are going to look like, what your average deductions are going to look like for each product that you are selling. All of this stuff is very important for companies to have on hand and be able to actually analyze and take action off of, right? If you don't have budgets built out, if you don't have forecasts built out, if you don't really understand your business from every, point of view, especially on the finance related side, it's very difficult to grow efficiently and make sure that you're going to be around, call it, for the next holiday season, right? Or even be able to make it into the holidays. There's a lot of companies that I've seen that are like, well, we're a very seasonal business, and our peak season is obviously during the holidays and everything. And then we're looking kind of, during the off-peak cycles, and all that's happened is that maybe revenue has stayed flat, or maybe revenue has gone up a little bit, but their expenses exploded, right? Like they're spending a lot more money than they would have last year because they actually think that they have traction now. They're like, oh, well, I'm a seasonal business, I'm going to make up for this, during my holiday peak season, whatever it may be, and I will turn to cash flow positive or profitable, or only at a smaller loss than I was at the month after, and the month prior, or the year prior. And my biggest thing to them is that, listen, if you want to invest in your business, invest in those tools, in those resources that are going to be able to actually provide you with true insights of what's going on with your business, right? And I'm sure, just like you, a big proponent of tech, right? That there's a lot of great tech solutions that customers can really, or brands can bring into their business that can, lead to more efficiencies, whether it's from a supply chain logistics standpoint, from a finance standpoint, even from a sales and marketing standpoint.
Yeah. So if I'm sitting here, it might be a consideration to go in and say, hey, can I leverage a piece of software that can help me get a better feel for, my revenue, expenses, all of these kind of bullet points here. I don't need to go hire an MBA on staff, right? This is something that I could probably just talk to the guys at Ampla about, get a little advice on, and use some tools to better understand. But yeah, you gave us a little preview there of your next slide, which I think is really down to brass tacks, right? Like I've gone through, I've looked at my margins, I've done some budgeting, I've deprecated some SKUs that haven't been selling, I'm spending too much money on, I'm only putting ad spend where I need to, right? I've got a handle now on kind of my projections on my models. So now I'm ready to show up and capitalize my business, right? I need to make sure that I got cash flow to keep everybody employed and keep growing over the next, 4 to 6 months. So what do I do?
Yep, absolutely. So first and foremost, listen, we've seen a ton of new VCs spring up in the past, few years, right? You're also seeing a lot of successful founders of businesses that were acquired, starting their own VC funds as well. And, not only do they bring capital to the table, they bring a lot of experience and advice and all that as well. So, first and foremost, like you mentioned, if everything, you put your business on a good path, right? You understand the mechanics of it. You understand kind of what's, moving the needle from a top line, bottom line perspective. You have an understanding of where you need to invest or what you can invest in to continue to make the business grow. Now you definitely are ready for some, call it, equity capital, right? And again, I do want to be mindful of the fact that, are you going to probably get the valuation that you're seeking, especially in today's market? Probably not, right? Would you have gotten it 6, 9, 12 months ago? Yeah, probably. I'm sure you probably could have even gotten higher. But again, at the same time, it goes, what is fair, or what do the investor believe that they're also going to be able to make money off of this in the, if some type of event happens, right? Like an acquisition or IPO or whatever it may be. So first and foremost, point one over here is that if your business is on a good path, you're obviously raising capital to grow the business. You're not, raising to save it. Unfortunately, there are a lot of companies that have either raised capital in the past, or were doing incredibly well and got hit with, kind of current factors that are going on, and now they're out of cash. And runway is getting, worse and worse on a week by week basis. Unfortunately, those types of businesses are struggling to raise capital, especially equity capital, right? And what ends up happening in that situation is they're heavily discounting their valuation, or they are actually now going and trying to go through some type of sale or a merger, right? And in some instances, they do happen. And whether the founders make out or they're able to return capital to their investors, there are certain situations where that can happen. There's a positive outcome, and more cases than not, that there's obviously not. But if you have the ability to grow your business, right, then great. Let's go to the VC world. What do the VC world care about? Well, what are you going to be doing, 5 years down the road? What's the exit strategy? How much am I going to make off of this investment? And this is where I tell people, and, I did a webinar on this as well, is like, you have to create FOMO with the VC world, right? You pretty much have to go out there, and kind of like, puff your chest out, toot your own horn a bit and be like, listen, I would love to have you as a part of this ride. But if you don't, I got the next, 6 or 7 VCs in my back pocket that are ready to take this journey with me, right? And again, it all comes down to having the right valuation, having the right vision, making sure that your exit strategy is sound, right? And that the investor that you're going to, listen, if you just want the money and you feel like you figured it out on your own, that's fine. We did that for our first round as well, and it worked out for us. But if you do need help and guidance along the way, make sure you're looking for the right investor that can provide you that support, that has the time to provide that support. And it's great to say that there are a lot of VCs, a lot of founder, led VCs that are doing just that. Right.
Yeah, I would echo that last point that, we have benefited from having, been there, done that investors who can give us a ton of guidance and feedback and, help us to really refine our thinking. And I believe that is a vital piece of having a good investor is having somebody who can really kind of tell you from having been there before, what you need to kind of some of the mistakes that you can avoid and some of the decisions that are really important for you to be able to focus on early on. So.
Absolutely. And then obviously, and I'm very well versed in is debt capital, right? And debt capital, you're seeing a lot more lenders out there. You're seeing them as your traditional asset-based lenders, right? Like I said earlier, where they're lending you based off of a certain percentage of your accounts receivable or your inventory. You tend to see those traditional guys not being great solutions for your D2C customers because they really, they haven't figured out how to calculate, the sales coming in from D2C channels, right? Because that's more instant, right? So there's not actually any accounts receivable because that money is coming in and being cleared within the matter of days. But then you have, what sprung up from a lot of these D2C companies are merchant cash advances, right? So these are your Shopify Capital, Wayflyer, Clearco, et cetera. And they're primarily focusing on your D2C revenue, and they're lending you a certain amount against that. Now, the biggest difference between a merchant cash advance and a asset-based lender who's most likely going to provide you a revolving line of credit is that first and foremost, asset-based lenders aren't governed by any federal laws or state or whatever it is. And because of that, they actually can't quote you an APR. What they quote you is a fee, right? And this fee is based off of however many number of months, right? And that fee is due upfront, right? Based off of the amount that they're going to lend you, right? So let's just say you get approved for a loan from Shopify Capital. It's for 2% a month. You take it for 3 months. Now that's 6% that you're actually paying on that cost of capital, right? But that's taken upfront. So if you're borrowing, call it $100,000, $2,000 per month is going to be paid directly from that 100,000, right? Now, a lot of customers come to us and be like, well, I'm getting this loan for Shopify Capital for 1%. So that equates to 12% as the annualized APR. And we're like, unfortunately, that's not the case, right? The way that it works for us especially, is that we are able to quote an APR because we are governed and we are a regulated lender. And we are only charging you one all-in APR that is applied to the balance that is outstanding on any given day, right? So as customers pay back their loans, right? A lot of brands have the ability to pay back these term loans that they have. Instead of 3 months, they're paying it off in 2 months, right? Or they're paying it off in 1 month. Or, the payments are coming in on a daily basis and that balance outstanding is coming down. So the true APR for a lot of these MCAs actually end up being in the 20, 30, in some cases 40% range, depending on how much that term is for and what that fee associated with it is. So with us, how we kind of handle it is like, okay, we're basing it off of the cash collections, true revolving line of credit. We take your APR. So let's just say if your APR is 15%, you take 15% divided by 360, get your, small percentage, whatever it is. And then that's our daily APR, and that's only charged your balance outstanding, right? So the maximum that you will pay in a year with us is 15%, when in most cases it's a lot less because their balance outstanding is never that full amount that they borrowed or what they were approved for.
And I will also just add in for those uninitiated who maybe haven't even been to the website or even looked at Ampla before, you also get a great dashboard that tells you exactly where you are. So it's also very easy to keep track of from just a management perspective. So you're not going to have to do a bunch of additional paperwork to just kind of figure out where you're at and how much you owe. So
yeah. And also, so we just launched the bank recently as well in June. So we are a fully FDIC insured bank. And pretty much what we're starting to see and experience is that people like the fact that everything is in one place, right? In one portal, one sign in. We're coming out with like a bill pay feature, which actually should be launching today, and some card solutions. So people like the fact that they're kind of doing all of their business banking, borrowing, with us. And the goal is to provide as much transparency as possible, right? So, people, interest rates going up, don't get me wrong, our cost of capital or our cost of borrowing has also gone up as well. We're not here to try to just completely pass that off to our customer. But again, they understand that they're going to feel the effects of like the higher Fed fund rate, et cetera, which is going to be slightly higher in the cost of capital. But how we have structured it with the daily APR, we're only talking about, a couple $100 more per month, where with these MCAs, it can end up being a couple $1,000 more per month.
Yeah. So pulling all the pieces together here, Kunal. So we've, obviously we love Ampla because you guys have got, lots of folks on staff like yourself who have been founders, who've been on the other side of the table and sat in the other seat and had to work through all of this stuff. So, if you're in the elevator here and you've got to just kind of give someone the word of wisdom on what they need to be thinking about and what they need to do, what do we take away from this?
First and foremost, margins, right? Always make sure that your net margins, your contribution margins, there's always a plan to continuously improve them, right? Because if you can't improve them, you're going to be stuck. You're going to be presented with challenges when you need to invest in the business. And all that's going to happen is that your bottom line is going to look worse, right? And no longer are we in the world where, these major conglomerates are only looking at your top line revenue and are going to give you a 5, 6, 10x multiple of that, right? While they may give you a multiple of your top line, they're looking at what that bottom line looks like. They're looking at what that net operating income is looking like, right? Second of all, you have to be smart with your money in this type of environment. And if that means daily, weekly cash flow projections, it needs to be done. We actually advise our customers and provide them with a template of a 13-week cash flow model. And this was, what a lot of investment bankers do. Obviously, our founder was an investment banker himself. And the 13-week cash flow model is so helpful because it can really help you understand what are those inflows, what are those outflows, how much cash do I have on hand, how much more cash am I going to potentially need, and then continue to build and grow from there, right? And again, I know that there's been a lot of like, I'm not going to say negativity, but it's like be afraid, be scared, or like what we've been talking about, kind of this. But don't be also afraid to invest in certain activities that are working, that you can prove that are working, right? Because if you're seeing a higher ROAS on Facebook versus Google, either continue to decrease spends on Google and add it to Facebook, or completely turn that channel off and add even more dollars to it, right? If you have the ability to do it and you know that you're going to net more money or better returns off of it, make that investment, be confident in that investment, right? And anything else, such as a Blue Onion, such as Ampla and our insights and all that stuff as well. If you have the ability to invest in tech that is going to lead to more efficiencies, don't hesitate to do that as well.
Yeah. Well, I think that is a good message for everyone. Is there's a lot of doom and gloom around the inflation numbers we're seeing around the economy, but I think that I'm still excited by the brands that we get to talk to. It's always fun to see the ways that people are positioning their products, the ideas that people have come up with. And I think that, the main message that I would have for anybody is, yeah, it's going to be a little bit tougher. But you know what? Just go and do the next right thing that's in front of you, tackle the next day's challenges and talk to people, right? Like reach out, talk to folks, talk to Kunal, talk to folks at Blue Onion. We'd love to tell you what we're hearing, right? Like if we can help a company succeed, we think that that's a great thing. And we want to create a real symbiotic kind of ecosystem of companies and tech and services and institutions like Ampla that can help these companies succeed, because we really believe that when every D2C company, when one D2C company succeeds, every D2C company is going to be able to succeed in the wake of that. And so, we want to see more Allbirds, and we want to see more Figs, and we want to see more of these great, big D2C brands that have made it and made a dent and are really challenging and innovating in the space, because that means better products for us consumers. So it's always exciting to get to buy a new product. So I'm looking forward to the holiday season and loading up on some new products. So I'll be out there trying to float some businesses, and I'm sure you will as well, Kunal. So very very grateful for you taking some time out to spend with us here today. How can we get a hold of you?
Sure. So, feel free to email me, kunal.kohli@getampla.com. Even if, it's just for some advice or whatever it may be, more than happy to help. And, you can also go to our website, getampla.com. And, we have a lot of great people here, like you said, and everyone's always willing to help.
Awesome. Well, I know you got to go and fund some more brands here. So you go out there and get after it, and appreciate you sharing your insights here. If there's anything in watching this that you want to do a deeper dive on, anything that you say, hey, how are you guys thinking about logistics, manufacturing? These are, gray areas that I don't know anything about. Help me understand it. Like, definitely hit us up, and happy to dive deeper on any of these topics. So thanks again, and hope everybody has a great rest of your week, wherever you are. And we'll look forward to hearing from you soon.
Thank you.